With us now on Voices of Wall Street is Gil Luria. He's the head of institutional research at D.A. Davidson. Gil, it's great to see you here. Initiating coverage now on Coinbase. You've got a buy rating, 195 price target. You are calling this, quote, an Amazon moment for crypto. That is quite a comparison there. So tell us why you're so bullish and how do you mean by, this moment for them being an Amazon moment?
Well, crypto has become huge. Over the last 11 years, the growth has been spectacular. It's $1 trillion category for crypto assets, but it's really gone on a parallel path to traditional finance and Wall Street. And I think that the Coinbase direct listing, when Coinbase becomes public and starts trading at $50 billion market cap and above, those two worlds will combine, collide, and become intertwined, and forever. There will not be any more separating of what crypto is from the rest of finance, and I think that's a monumental point in time. Which is why we wanted to come out early and let people know that we think this Coinbase listing is going to be a very big deal. It's going to be a big deal for crypto and for a very good company in Coinbase.
And I was combining my questions there. I was trying to ask you what you mean, but also I was thinking about how you actually see the significance of this coming to the public markets. There have been so much debate around how Bitcoin interacts with the rest of the financial markets. So I'd love to understand from your perspective the significance there.
So crypto assets in themselves are not cash flow generating assets. And so it's hard for traditional institutional investors to wrap their heads around them. It's a financial instrument unlike any that we've had before. Coinbase is a free cash flow generating company. In fact, they generate quite a bit of cash flow. They generated over 500 million of cash flow last year, which is very significant. It's a big company and they're growing incredibly fast. So it's easier for us to wrap our head around it. It's easier for institutional investors to wrap their heads around this company as a company that generates cash flow. They happen to be in the business of facilitating trading of crypto assets, but they're a traditional company that takes in dollars and generates profits in dollars. And so that's, to me, the entry point for Wall Street into crypto in a significant way. Now, having said that, it's not that institutional investors aren't getting involved in crypto assets anyway, but it's been almost an aside up until now, and now it's going to become center stage.
Let's talk more about the business model. Where's the cash flow coming from? It looks like they generated over $3.4 billion in just total overall revenue as of the end of last year. Break the pie down for us.
A vast majority of their revenue comes from the fees and commissions on trading crypto assets. So they have a consumer product, a wallet that looks a lot like PayPal or the Square app or Robinhood, where you can buy these crypto assets. You pay when you buy them, you pay when you sell them. And then they also have an exchange, a crypto exchange, where they serve both institutions and other more trading-oriented crypto asset traders. And they charge a commission there as well. So that's a vast majority of their revenue. They generate some revenue from subscription services that are tied to the assets that they have. And there's a growing number of those. But more than 85% of revenue is still commissions and fees on trading crypto assets.
We remember when all of the traditional brokerages online got away from fees, really driven by Robinhood. How much of that could come into play here as a factor for their future if transaction fees have to come down, first of all, if more competition comes along, or if they have to get rid of them altogether? How does that really then value, as an analyst, how would you then value Coinbase?
They are very highly motivated to get a more recurring stream of revenue. So they're very much focused on increasing subscription type services to their customers. Having said that, they've faced a lot of competition since they began in 2012. And what's interesting here is that Bitcoin and crypto assets are open source software. So anybody can have an exchange, anybody can have a wallet. The reason Coinbase has done so well is the user experience is great. They've kept their platform secure. It's been highly regulatory friendly. So they're already winning in terms of competition. Not a doubt that there'll be more competition, but they've been able to keep their price point in the face of competition. Their motivation to have more recurring revenue has to do with the fact that it'll smooth their results going forward. Right now, the results are susceptible to the ups and downs of the crypto market, to the volatility of the crypto market. And so they have good years and not as good years. The more subscription revenue they have, the more they can smooth out their results, which is better for instance, public company investors.
Let's talk about the competition, since we're talking about it now. You're bringing it up, and it's not new, as you mentioned. So you've got Grayscale, Kraken, Gemini, and then consumer digital wallets in the form of Square, PayPal, and Robinhood. User experience, you mentioned, was one big factor that differentiates Coinbase from the rest. Are there other parts of these companies that maybe Coinbase could take from to strengthen either their offering or their experience overall?
So I'd say Grayscale is the other very meaningful competitor here. They have done a fantastic job at grabbing the bigger accounts, the institutional enterprise level customers that are really invested in the long term. They have a minimum to invest in the trust itself. They've created a tradable security that's GBTC that already trades on the exchanges. So they've done a fantastic job. Again, a very well managed company, very thoughtfully managed company. The other two big US exchanges, Kraken and Gemini, are meaningful. But I'd also have to think about PayPal, Square, Robinhood, the other folks that allow you to hold crypto assets in your wallet. It's not a big part of their business, but it drives their stock, and so they're focused on it. And so those are also meaningful competitors. So Coinbase won't be able to rest on its laurels. They have to keep facing competition on both sides.
Okay, that's good. Thanks for going through some of those. I want to look at some of maybe their future potential. Commerce being a big part of it as well. There are some, companies that we've been watching, Tesla most notably, saying that maybe in the future, cryptocurrencies, Bitcoins may be used as a form of payment. They already have Coinbase Commerce, a service that allows online retailers with software, providing them with that software to accept some of those. I wonder, with the, introduction of Coinbase into the public markets with some more money kind of for them, do you foresee more retailers kind of trying this out because Coinbase has now sort of been vetted by the street?
It's possible. The payment network is one of the interesting uses for crypto assets. And in fact, if you go back to the original white paper published by pseudonymously under Satoshi Nakamoto, he referred to Bitcoin as a peer-to-peer electronic cash network. It was meant to be a better payment network originally, and there's still some people that believe that and are trying to create that as an application. But what's happened since then is crypto assets have delivered a lot of other applications and potential for a lot of other applications. Right now, it is a use case. You can use it to buy things online. There are some places where you can even use it offline. It's not necessarily currently the most compelling use case because as a consumer buying online, you never have to pay, and the experience is actually fairly straightforward. Bitcoin doesn't necessarily, or other crypto assets, improve that. But if you believe the true believers in crypto, and specifically in Bitcoin, where Bitcoin becomes one day a really global cash currency, digital cash currency, at that point, if a lot of people have Bitcoin in their wallet and they're transacting with it constantly, they'll also want to be able to buy things online. It's not the main application though right now, because anybody that's bought anything with Bitcoin in the last 10 years has regretted it because it kept going up. Famously, there's the story of the individual that bought a pizza 10 years ago with Bitcoin and paid 10,000 Bitcoin for that pizza at $50,000 of Bitcoin right now. I'm sure that he regrets it a little bit.
I like that. Yeah, that definitely is some very expensive pizza. One thing you note pretty clearly is, Coinbase holds about 11% of all crypto assets, and this may be kind of a good measure, maybe the best measure of sort of market share. How will you ultimately sort of measure success? I mean, this is sort of, I think, a diversified play that's not solely reliant on one asset.
That's right. So Coinbase has to keep up with the times. If other crypto assets become more important than Bitcoin, Ethereum, or the other assets that they provide access to, they need to adapt to those, especially these days. Centralized financial applications, DeFi applications are becoming more and more important. Coinbase is going to have to roll with it. They're going to have to figure out how to be involved with those assets, even as those assets create venues for trading crypto that are decentralized, meaning don't necessarily need Coinbase. So they're going to have to continue to adapt. It's safe to say, though, that they're in a good position to do that. Again, they've adapted every day since they started in 2012 while providing a good experience. So it'll be challenging ahead, but they've done a good job so far.
It's a question that, we ask a lot of these companies that are first to market, right? Is that advantage ultimately going to be good for them, or will they be, out innovated sort of in the future? But if we just focus on, Bitcoin just as one of these sort of asset classes here in the crypto space, will you look at Coinbase and how it moves to maybe to draw any correlation back to how Bitcoin prices might also be moving? Should anybody be looking into that relationship at all between the two?
That's right. So Bitcoin is still the main crypto asset. It still drives a lot of the activity, and its ups and downs, as well as the day-to-day volatility, drive Coinbase's results. So to your point, what's important here is for Coinbase to be a good public company investment, they're going to have to show less volatility than the underlying asset over time. They're going to have to show that they can grow even when Bitcoin's up, Bitcoin down, Bitcoin more volatile, less volatile. Coinbase is going to have to grow through that. And what people are really going to be looking for is it less volatile? Are you still enjoying the same levels of growth with less volatility? So that will be a very important thing to follow going forward.
I think one of the most notable parts about, this week's news, and I'm sure as an analyst, is, this is sort of a, more traditional IPO. At least it's a direct listing, but there is an S1. I mean, you can initiate coverage on this, and we know SPACs have been all the rage so far. I wonder if you have a take on, potentially why this was a good idea for Coinbase to come to market, versus all these, other methods. I mean, obviously I'm talking about SPACs mostly, but so I'd love to get your take on that.
Yeah, all three methods of going public are fit different situations. So for many and most companies, the traditional IPO route, if they're a fast-growing company that need to be able to tell a good story to the investment community, maybe they're not well known, maybe there's subtleties in the business that they want to explain, they want good price discovery about where they should go public, the IPO is a great route. If it's a household brand that everybody knows and is really large and everybody understands what they do and the financials aren't that complicated, like a Spotify, like a Coinbase, there's no reason not to do a direct listing. There's still disadvantages. The price discovery on day one could be painful, and you're putting your shares in hands that may be more interested in flipping it or trading it. So there's still risks to it, but for some companies it makes more sense. And then the SPAC route for good companies that don't want to take the long route and have an ability to exit via SPAC and go public that way and gather the following after that and explain their story after that, that's a valid path as well. It really depends on the type of company, their growth rates, how complicated they are, and it's good to have options.
I have to tell you, I've talked to a lot of companies that have kind of gone public through the SPAC vehicles that are now so popular. And you talk about how this might actually be sort of a shorter time period for them to go through that process. If you listen to them, they'll say, actually, no, the due diligence has been a lot longer. I'm always curious to get folks' take on, overall sort of sentiment on SPACs, if it's a sign of quality or not.
There's good ones and not as good ones. And again, through the IPO process, you get to really vet that story. Investors get to vet it. It's iterative. And you really only go out if it's a great story that people can buy into and it's been endorsed and underwritten and proven itself to be an IPO worthy company that didn't make sense for them to sell. A SPAC, it's a mixed bag. It's there's a lot of money sloshing around in SPACs, and some of them are buying fantastic companies that should be public, and some of them are buying not as good companies that maybe shouldn't be public. And as analysts and investors, we have to be more discerning for SPACs. But that doesn't mean there aren't good ones there. It just means we have to pay more attention and do more work.
Is it fair to say that the consistency of the quality is generally a bit higher ratio-wise through that traditional IPO process than through SPACs?
Overall, that's not an unfair statement, and you can see that in valuations. The IPOs that are going out, that are well vetted, go out at good valuations and tend to perform very well based on the work we've done. With SPACs, there's some that have done spectacularly well, getting great valuations, and obviously there's a lot that don't.
You're in a tough position. Lots of folks are now more interested in investing, retail investors especially. And, if you put out a note they don't agree with, you'll surely hear about it online somewhere. Gil, we appreciate your time today. As always, Gil Loria is Managing Director, Head of Institutional Research at D.A. Davidson. Thanks so much.
Thank you.